brief background about the series. Leading Conversation with FBN Quest is a webinar series to bring you markets and industry and customer insights and analysis. The series features leading professionals of FBN Quest and industry experts with experience in corporate and private management. We hope to open your mind to a world of opportunities, and we very look forward to engaging with you. The session will run for an hour, and we have a special guest, Professor Ziad Mohammed. Professor Ziad Mohammed is an associate professor, lead researcher, Sharia for Center of Excellence in Social Finance, and head online programs at INCEIF in Malaysia. Dr. Ziad has advised financial institutions and regulators in Islamic finance for almost 25 years. His work spans over 20 countries with over 12,000 participants on various aspects of finance. His advisory in capital markets has led to a certification of some of the largest sovereign and corporate sukuk issuance in Malaysia and Nigeria. He's also a consultant in World Bank. And if I should speak on his profile, I do not think we'll start this webinar today. Assalamu alaikum, Prof.
Wa alaikum salam wa rahmatullahi wa barakatuh, and thank you for the opportunity to share some of my thoughts on this honorable platform.
Thank you. There will be 3 polls within this session, and we crave your indulgence for an active participation. And please note there will be questions and answers at the end of the program. Please drop your questions via the chat room so that we can answer your questions. Now we're moving to this section, and we're going to start with a poll. Get ready for that poll, and then we'll kick off as quickly as possible. Are you familiar with ethical investments? Round down 1, 2, 3, 4. Just a single choice. Whoa. I did not expect that. A lot of people are not familiar with ethical investment. So you're at the right place. This is going to be very, very interesting. We have an expert that will take you on a journey, and I hope that at the end of the session, a lot more will know more about ethical finance. Prof, are we ready?
Yes, let's go.
Okay. First and foremost, what is Islamic finance and what makes it different from conventional finance?
Yes, a fundamental question, and thank you very much for that. This is the big question. What is the difference between non-interest finance or Islamic finance and conventional or interest-based finance? Well, if we were to use the titles non-interest finance versus interest-based finance, I think it's already telling what the key difference is. It lets the cat out of the bag, so to speak. Now, Islamic finance is not about cosmetics. It's not about wearing a different dress or a hat and having a beard and then suddenly being Islamic. And it is not also about doing things that are for a particular part of the population only. That is not what Islamic finance is. So I'm starting off from the basics of what it's not, because it's generally everything else. It's everything that's ethical, that's moral, that is expected to economically empower communities. And one would ask, well, then, isn't conventional also ethical and about community empowerment? Well, perhaps it is, but the manner in which it reaches there is different to how Islamic finance would do that. So let's talk a little bit about those very basics. Islamic finance, being without interest, is based on, firstly, the Islamic commercial law. Now, those Islamic commercial legal requirements are very universal in their model objectives. They want to ensure that there is justice and fairness for all, irrespective of religion, color, or creed, or even nationality. It is there to ensure moderation and mutual benefit, to ensure that both parties are going to get the best out of the contract. It's there to ensure that no harm is effected. And when we say no harm, that means that no harm is to the person that contracts, and no harm is to those that are impacted by the contract. And this means that when it comes to environmentally friendly objectives, looking like at climate change, or ensuring that the rights of the others are protected, and this includes the environment and animals, and responsible usage of all the resources, then Islamic finance prioritizes all of these elements. Finally, Islamic finance is about socio-economic empowerment, which means that it focuses on aspects of social finance and welfare. Now, this does not mean that it undermines the issue of making a profit. Of course, Islamic finance is all about making profits, but it is about doing that in a moderate, balanced, fair, and transparent method that ensures that there is no conflict that can arise, or it limits the conflict that can arise from the parties to the contract. I'll stop there. Perhaps, Islamic finance is a huge, huge subject. And right now, what we're going to attempt to do is just plant a few seeds and add a little bit of water. And it's going to take a time to actually develop and grow. But hopefully, with all the smart participants that are joining us today, they can then direct us to any specific issues that they may be having a bit later with regards to Islamic finance.
Thank you, Prof. Second question. Islamic finance is known to be guided by key principles. Could you please take us through them?
Sure. Islamic finance begins with the first principle, and we're going to call this principle GP. Like a general practitioner, you'd go to a doctor when you're ill. GP meaning general permissibility. Now, what this means is that Islamic finance sees everything as permissible unless it has been expressly prohibited. This is a fundamental concept. In other words, if you think of a football match, in a football match, if you were to explain how the game is played, then you tell the players that you've got to play within the four corners of the soccer field, and then you tell them that they need to score goals against each other using a ball. And then you'd emphasize the importance of not touching the ball. You can kick the ball, and except for the goalkeeper, everyone else is expected not to touch the ball. This is a fundamental prohibition. So in Islamic finance, we say, just like in football, you can do whatever you want on the field to score your goal, just stay away from the prohibitions. In Islamic finance, we say the same thing. You can do whatever you need to make a profit, just stay away from the prohibitions. So this is the first rule. Everything is allowed unless expressly prohibited. The second rule is to remove harm and promote beneficial transactions. So if you think about that football field again, and you've got all of these players playing on the field, and if someone throws a bottle onto the field, then you've got to remove the bottle because it could hurt someone whilst they're running on the field, and that could be quite devastating. It could stall the match. It could hurt someone and rush him to hospital. So these are harms that are in the playing area. You want to score a goal, but you need to remove any harm. In the same way, in Islamic finance, you need to remove what is considered a harm in Islamic finance. And we're going to get to what is considered a harm just now. The next principle is a key principle in the core of Islamic finance, and it states that profit follows responsibility. And you'll hear this a lot in Islamic finance. They will say, it's all about risk sharing. It's all about profit and loss. This key component or principle of Islamic finance means that it's unfair for me to deposit an amount with you and say, I demand 10% at the end of the year, very much like a fixed deposit. In Islamic finance, I invest money, I am exposed to risk, and because I am exposed to risk, I have a right to share in the profit. And naturally, when we invest in organizations like FBN Quest and others, then the professional asset managers are not there to lose our money. That's why we go to them rather than a corner shop. And because of that, we expect profits, but naturally, when it comes to losses, we need to be exposed to that as well. Finally, and this is the crux of Islamic finance, money is not a rentable commodity. What does this mean? It means that I can't lend money to someone and ask for more back. I can't ask for a charge for the use of money. I can't ask for rent for using a loan. So money cannot be rented for more money. And this is an old concept in humanity, all the way from the Greek philosophers. Aristotle said money cannot beget more money in itself. And then various doctrines, religions, all prohibited various aspects of interest, calling it usury and different forms. So it's not new to Islamic finance. Islamic finance, based on Islamic law, simply carried forward those very same injunctions that you will find in Judaism and Christianity, and then provided some clear conditions around it, stating that it cannot be an advantage or a benefit to the lender over a specified period, and it cannot be a condition of the loan. So just to recap, GP, general permissibility, you can do as you like, just stay away from the prohibitions, make sure you remove harm and promote goodness, ensure that when you want a profit, it's exposed to some loss as well, because profit follows responsibility, and then do not rent money. Engage money as a form of capital, but don't rent it, and therefore interest and all forms of interest are then impermissible. I'll stop there.
Very fascinating, Prof. Very fascinating. I'll quickly go to the next question. What are the common instruments in Islamic finance?
Yes, excellent. Now, if you go into a conventional bank and you need financing for a house or for a car, then you take a loan. The bank itself may call it a mortgage financing or a car financing, motor vehicle financing, but essentially it's always the same concept. They're going to lend you money and you're going to pay more back in return. And that's the bottom line. If you default, they're going to charge you a penalty on that default, And then as you default for longer periods, they're going to compound the interest and charge you even more. Now, Islamic finance also provides this type of structure for motor vehicles and houses and education and everything else, just like conventional does, but the underlying contracts or instruments are different. And here, for example, if you wanted a house financed, then the Islamic bank or the non-interest bank will buy the property, will purchase the house, and then sell it back to you in portions. It may sell it back to you in equity portions, or it may rent the property to you with the objective of you becoming the owner at the end of the period, sort of a rent to own perspective. Now, although the installment may be increased if we were to divide it in terms of what the principal is, then there is a rental, and that's the profit to the bank and its shareholders. There is a sale price with a markup, and that's the profit to the bank. So it's not as if the bank is a welfare institution. The bank is still making money, but it's doing it in a way that sells real assets. It's always linked to the real economy. And if you were to default, yes, there is a deterrent, a penalty, but that penalty is not taken by the bank. The bank has to give that in charity. And there is no compounding at an Islamic bank. It's always the price that you initially agreed to pay that you will pay. If it's a sale transaction, if it's a rental, then the rentals can be adjusted through mutual consent over the period. Now, this will work for motor vehicle financing as well. In the same instance, you wanted that dream car, that BMW, that Mercedes-Benz, or that Toyota Camry, and you wanted it financed through an Islamic bank. Well, the process would be that the Islamic bank will purchase the vehicle first, and then rent the vehicle to you, or sell the vehicle in equal installments to you over a specified period. And the price doesn't change. The price is always what was agreed up front. And therefore, there's no interest involved. It's actually a sale transaction or a lease transaction or a partnership transaction. And that is the way Islamic finance instruments are structured. And you can have a variety. Every conventional instrument has an equivalent Islamic finance instrument today. In Nigeria, you're still developing and evolving your instruments. You may not have a like for like at this stage, but I'd say you're quite far down the line, 70, 80%, you have equivalent instruments that are offered in Islamic, and that includes investments like equities and the equivalent of bonds in the form of sukuk as well.
Thank you, Prof. Next question, is sukuk bond different from traditional bonds? If yes, what are the important differences?
This is a great question. And, you know, the importance of this question is that if we look at infrastructure financing today or funding large corporate sovereigns, then it's bonds and debt that are often used to fund these structures. Now, the challenge here is that bonds have interest, and bonds are not always linked to the underlying economic activity. In fact, I'd rather not use the word always. I'd say they're rarely linked to the actual economic activities and projects that are beneath them, because the bonds just create cash flow and liquidity, and they may be used for a variety of activities. And finally, the interest portion or the coupon is then provided for the bond. Now, how does a sukuk differ? Well, interestingly, and maybe I'd like to mention this little anecdote of where sukuk actually emanate. You see, long, long ago, in a land far away, as most fairy tales begin, the Islamic Empire stretched across from modern-day Iran, which is Persia, old Persia, all the way to Cordoba or Cordoba, which is modern-day Spain. Now, traders used to have to take their caravans full of goods and then traverse that path of North Africa and sell their goods. But the challenge is, well, bandits. So we have robbers. And if they were to rely on the security of the governance, they would lose all their wealth soon after they left, because there was a lot of open land, and bandits would take advantage of that. So what they did was they used to sell their goods along the way and collect gold. Now, again, gold is even more risky to carry because robbers would come in and then they would steal the gold. So they would take the gold, the owners of the caravans would take the gold and deposit that gold along the way. So there were gold repositories throughout North Africa, like in Trablus, which is Tripoli in Libya. And then all the way along, they would deposit that with safe keepers, people that had good security and were known to keep these kind of custody. Now, they would get a receipt for their gold. They would take the receipt and use the receipt to trade and buy other goods and then sell those goods elsewhere. Those receipts were called sak, singular sak. In plural, it's called sukuk. Now, they would take those receipts, and if you think about that, those Arabic words, sukuk and sak, that was then Latinized and turned into French, and finally, what we have today is called check. So the sak is the derivation, according to a famous academic, Udovic, in his work in 1976. He states that the origin of the word check that we use all the time, or we often used to use, it's now declining in usage, but that check has its foundations in 1400-year-old sak, which is that receipt. So sukuk are a well-known instrument in Islamic finance, and they are simply a certificate of ownership. That's all it is. The difference is that since 2000, in fact, the first sukuk was issued in 1985, way back, in 1985. You had another one in 1995, 2001, and several others were issued thereafter, but it was issued first in Malaysia. And those sukuk, all they were investment certificates representing ownership of underlying assets or projects. Shell Oil, the Dutch company, was the first to issue a sukuk. Yes, a non-Muslim company issuing an Islamic certificate to raise capital. And they raised capital using this because it had a real underlying project. So investors were confident that their money was being used for a real project. The cash flows were predetermined, so they knew what to expect for the period. It was very carefully structured because it had good governance. It had Sharia compliance, and Sharia compliance adds a new level of governance to the sukuk. It was tradable. The certificate was tradable, just as a bond is tradable. And then, as bonds are rated, a sukuk is also rated. So a sukuk generally would have a credit rating, like Augusto and Co. in Nigeria would come in and rate a bond. Well, then, in the same way you'd rate a sukuk. So now a sukuk fulfills all of the requirements of a bond. How? It is an almost principal guaranteed certificate. It provides an almost guaranteed coupon, which is a dividend in terms of sukuk, but it's carefully determined, it's rated, and it's tradable. So it now follows almost all the characteristics of a bond, except that it's linked to the real economy. It's Sharia compliant. That means it complies with the Islamic law. It has guarantees and sovereign guarantees in the case of a sovereign sukuk that ensure that the investor is protected. And the dividends are very similar to the coupons on a bond, except that the dividends are derived from the actual underlying project. Now, that means that the potential for abandoning the project, like bonds are often abandoned, and the coupon rates are simply given from, the obligation. Sukuk are different. They rely on the completion of the project and the underlying dividends that would emanate from the rentals, of, for example, of that project. So there is a responsibility to complete a project. And therefore, investors are really promoting infrastructure development or company empowerment and development. And there's really, a connection here to growing the economy. Bonds also grow the economy, but bonds are slightly disconnected as compared to sukuk. Sukuk are not perfect. They are full of all of the human elements that bonds may be, exposed to, but they do have governance mechanisms that tend to mitigate at least some of the risk that would be prevalent in bonds. I'd stop there. Sukuk requires a huge discussion, but I hope that this will just explain the basics of what sukuk are.
Thank you so much, Prof. Brilliant discussion. Let's get ready for the second poll. So we get ready for the second part as well. Poll coming shortly. After the count of 4, 1, 2, 3, 4. Wow. Most people wing how they invest. Very fascinating. I think the second one is I have a financial advisor, and the last one is I don't invest. Very fascinating. Hopefully, at the end of this session, you'll change your mind on the best way to invest. Okay, Prof, back to you. We just had a breather. Okay, I'm going swiftly to the next question. Is Sukuk bond different from traditional bonds? If yes, oh, apologies. Talking of mutual funds like we have in conventional finance, do we have Sharia compliant mutual funds?
Yes, absolutely. We do have Sharia compliant mutual funds or unit trusts. It's just that they operate using another layer of governance and criteria to screen them or filter what is regarded as an acceptable share. So simply speaking, if you look at the Malaysian scenario, you may have around 800 companies that are listed on the Malaysian exchange. You'll have a few thousand that are listed on the Dow Jones. Now, in order to determine whether I can invest in a company or not, I've got to apply a screening criteria. And screening criteria for Islamic stocks means that I've got to first test whether the company that I want to invest in is involved in something that is prohibited in Islamic law or not. So if a company is involved in anything to do with alcohol or porcine products or gambling or anything to do with conventional finance like interest-based products or conventional insurance, then I can't invest in those companies. So it already fails the first screen. Now, if it passes the first screen and it doesn't fall within those prohibitions, then we can go to the other screens. And I won't go into the details of each of the screens, but generally what we check is the soundness of the company's financial ratios. So we would check the gearing ratio, for example, the debt equity ratio. And if the debt equity ratio is above a third, it means that the company is heavily indebted. And the Sharia scholars tend to be very cautious when a company is leveraged heavily, because they say that when you're buying a share, then you're actually buying much of a debt. So for companies that are less leveraged. That means they pass the debt equity ratio screen. They are less than a third. And then they have a good current ratio, a good liquidity ratio. And then the impermissible income, which is a very important aspect of screening. The impermissible income, that means any income that has been earned through interest or any incidental prohibited elements, that income cannot exceed more than 5% of the total income of the company. If it does, it's disqualified. If it is within the 5%, then the company can be included in the shares, in the share pool, but it doesn't stop there. Let's say a company has a prohibition of income at about 3%. It means that the investor, when he or she receives their statement, then there is a purification process that should take place on the dividends that are received. That 3% is impermissible. So the investor now can purify his or her dividends by giving 3% out in charity. So that's how a share is selected. In a mutual fund, several company shares are selected and put into a basket, and that is marketed as a packaged investment. And naturally, each of the companies that are included in the mutual fund will have to go through the same screening process that I've just mentioned if they are to qualify for this mutual fund. So it's a long answer to your short question, do we have Sharia compliant mutual funds? The answer is yes, as long as they follow the screening criteria.
Thank you, Prof. Now, let me ask this generic question. What are open-ended funds?
Well, this is a question that you are better able to answer than I am. But open-ended funds versus closed-ended funds are typically your funds that are based on what fund managers actively do in terms of investments during the day, which means there's no limit to how many shares the open-ended fund can offer. The shares are unlimited. They can continue to provide these as long as there is appetite. A closed-ended fund would be slightly different. It would have a limited amount of shares, and therefore, when it comes to closed-ended funds, it could be through invitation. There could be a very specific period of offering those funds or those shares, and therefore, it could be just whoever decides or is able to invest within the period of investment, they would be then included, and everyone else that missed the boat, unfortunately, they would not be able to benefit. I've tried to summarize it. Of course, it's not a Sharia question or an Islamic question, but as I say, you are the expert on open-ended versus closed-ended, but I hope that provides a little bit of insight on how this can be understood.
Thank you so much, Prof, for that. A separate cheeky question that we slipped in. We will take a short break for the third poll to allow people to digest what Prof has explained and gearing for the chats on this special question. Ready, go. Are your investments aligned with your faith and beliefs? 1, 2, 3, 4. Wow, impressive. We had most of the response are that the investments aligned with their beliefs, which is very good. Okay, I don't have to say too much. So let's get ready for more questions for the Prof. Okay, Prof, transparency, they say, is vital. How does one get to know whether his or her investment is invested in a Sharia compliant way?
Now, it depends on how you invest. So if you attempt to invest on your own, it does become quite challenging, and you now need to employ a screening app that would be able to screen the stocks in the jurisdiction that you'd like to invest in. That does become a bit challenging, as I say, because there are differences of opinion on what would be acceptable in different jurisdictions. The other option is to consider a financial advisor who is knowledgeable in Sharia compliant stocks. And that financial advisor would then guide you to select the best stocks that fall within the screening criteria. And then finally, if you go to a financial advisor like FBN Quest as an asset manager, well, then placement will be within Sharia compliant stocks as determined by their advisory council of experts. Now, this means that if you wanted to find out about your stock and the Sharia compliance of it, or your investment and the Sharia compliance of it, it becomes a lot easier because you have a governing body. And the governing body, the advisory council of experts, is made up of authoritative scholars in the field of Islamic finance and Islamic law, but they also are well acquainted with conventional investments and conventional finance. And they provide resolutions for the company. They would sift out or assist the company in sifting out what is Sharia compliant, and then insist on transparency and disclosure of the investments to the investor. So the investor has access to a fund fact sheet that will talk about Sharia compliance. The investor also has access to annual reports that will be provided by the asset manager. And of course, the asset manager involved in Sharia compliant investments must issue an annual report from their ACE, from the Advisory Council of Experts, that attests to the Sharia legitimacy or the compliance of all investments that were made in the previous year. And also, if anything was purified or given out in charity, the ACE would approve that officially in writing in the annual report. So this is the level of transparency that you would get if you were to go to an asset manager that is claiming Sharia compliance. So you need to check, naturally, if your financial advisor or asset manager has an ACE who can provide you with that level of comfort when it comes to your beliefs and your faith requirements.
Thank you, Prof. Now, and final question is, there is a common saying that Islamic finance is value-based rather than money-based. Would you please explain on this or expatiate on it?
Now, this is a crucial question in understanding the core tenets and the spirit of Islamic finance. Islamic finance really is based on, as we said earlier, socio-economic empowerment and upliftment. It wants to build society. And in order to do that, it must achieve it through a value-based level of intermediation. Now, intermediation is what banks offer. Basically, they are intermediaries between the surplus money that's available through depositors and shareholders and the deficit, meaning those that need financing. So they just match. They are agents, they are intermediaries, they act as an intermediary function, what we call as a black box, to be honest, in economics and finance. Now, value-based means that they simply don't match surplus and deficit. They match them intelligibly, responsibly. They match those seeking finance that are involved in good and wholesome businesses. They don't match those that are involved in immoral activities or activities that may result in harm to the environment or to the economy. And even fossil fuels, for example, they would match those that need financing for fossil fuels, but there would be clear parameters and limitations on how that is provided. When it comes to palm oil, like it's done in Malaysia, it needs to be responsible and sustainable palm oil. When it's investments that are made, there would be a screening level of ESG, ethical, environmental, social, governance, and responsible impact investments, SRI, and all of these screens would be used. This is the value-based spirit of Islamic investments and Islamic finance that investors can expect to achieve. Now, I must state that unfortunately, not all Islamic investments are ESG or responsible or value-based. And therefore, the discerning investor needs to ask these questions. Is my investment going into value-based initiatives? Is it going into ESG? Because then you know that it's responsible, it's looking after the environment, and it's taking care of all the indirect stakeholders as well. And this is what Islamic finance and investment is supposed to be all about. It doesn't mean that if we are to finance fossil fuels, that it's impermissible, but certainly it's not the best way to go. And therefore, value-based is where we focus our Islamic investments today.
Thank you, Prof, for that impactful answer. And I think I've learned a lot from what you've said. Every time you speak, learn every day. Thank you so much for all the responses and your patience. Please, we would like, if you have any questions, drop it in the Q&A box so that we can utilize the fact Prof is here. There's no stupid question. Please, we're ready for anything you have to say. The floor is open. As soon as the questions come in, I would ask the Prof. Thank you. So we'll give a few minutes for question and answer. Q&A. Wow. Prof, question 1. Are there any tax? Hold on a minute. Just, I think it's popped out again. Okay, I'm trying to quickly get to the questions. Let me start from the first one. Okay, apologies for this. First of all, is it true that loss is shared too in Islamic investment?
Islamic investment is fair. It is not one-sided. It doesn't favor the customer over the asset manager or the asset manager over the customer. And that means that both parties must be mutually benefiting from the transaction. Yes, to answer your question, loss is shared as well in Islamic investment. However, an asset manager is not in the business of losing people's money. An Islamic bank is not in the business of losing people's money, and that's why you place your funds there. So it's the calculated risk that you are taking in placing your funds with skilled people that know how to place funds, know how to invest, and therefore, if losses are experienced, then it is because of real business fluctuations and cycles. And that is normal because you're benefiting on the upside as well. You're benefiting when the business does well. And if the business is run responsibly, then you should not be suffering losses. And if there happen to be losses, well, then there would be a share for you in the losses. However, there are several risk mitigants in place to protect you from losing your funds.
Thank you, Prof. Another question. Good morning, Prof. Kindly give more light on the role of auditors in determining profitability of funding provided to customers by an ethical funding institution. where regulations around audit practices are not strong enough to punish based on deliberate wrong opinion, how can checks be put in place to determine profit earned from the investment?
There are several layers of checks and governance within these institutions. So this means that you would have your standard 3 lines of defense. And through those lines of defense, you're trying to mitigate the potential for missing a risk. And with our new approaches or our modern approaches of risk-based auditing, even ethical institutions will be audited through an audit plan that identifies what is most risky. That means certain institutions may have peculiar risks, like they may have a human capacity risk where they don't have adequate skilled personnel. They may have issues in publication or publishing their financial statements or in the selection of their investments. So it may be more specific, and that's why we use risk-based auditing to structure that. In addition, you have the layer of Sharia advisory, which is the Sharia review and the Sharia audit, which is in addition to the existing processes and practices. And then you have Sharia governance. And then, of course, you have the ACE, the Advisory Council of Experts, that conduct another audit. Then there is an external Sharia audit. So there are several mechanisms in place to identify risks. Now, when it comes to the issue of punishment or enforcement, yes, now that's going to be up to regulation. Regulation is going to have to do that. You can't do that in an isolated scenario. However, your advisory council of experts can levy a punishment, which is a fine in the event of non-compliance. And this is where, if a transaction is deemed to be non-compliant, then all profits earned from that transaction must be given to charity, and the institution loses from all the work that they've put in. So there are governance practices that we utilize to try to enforce the compliance requirements at these institutions.
Thank you, Prof. What role does Prof see Islamic finance playing the emerging global market, especially for investment? Okay, what role does he see Islamic finance playing in the emerging global market, especially for investment?
The impact has already been quite telling. It's because Islamic investment focuses on the real economy, and because of that real economy financing or investment means that you do really see the project, you see the output. And this is a shift away from pure liquidity financing, where you may not ever see what's going on with the money, and it may then dissipate or disappear. Here, you do see it in real projects. So this is a key contribution that Islamic finance is playing in the emerging global markets. And that is to do, again, with the governance layers that are added when you are operating within the Islamic finance sphere. So Islamic finance is learning from conventional, and conventional is also learning from Islamic. Islamic focuses on ethical and sustainable practices, and conventional is adopting that. Islamic also focuses on the importance of responsible financing, where there's fairness, there's literacy. The customer must know what he is entering into. And here, global markets do that on a checkbox basis. Islamic finance does that on a spirit basis. That means it must be implemented. There must be a mutual understanding. Even, and I say this carefully, all Islamic asset managers or financing institutions don't necessarily apply all the Islamic expectations. This is true and unfortunate. But overall, it doesn't change the principles of what Islamic finance stands for. And this is contributing to the emerging global market, especially within the investment space.
Okay, thank you, Prof. There's a question on the Sukuk bond. How does one make profit?
Well, a Sukuk is a very carefully sophisticated, structured investment where we determine well in advance what is going to happen over the next 3-5 years, or however long the sukuk is in play until maturity. We try to determine as far as possible what the cash flows are. And those cash flows emanate from typically rentals of properties that are bought through the sukuk, or a rental that government pays, a rent that government pays for an infrastructure project like a road, like the FGN sukuk. So the government is, utilizing the road for the sake of the public. The government pays rental. The public may pay toll, and all of that gets accumulated to be paid out as dividend at the end of the day. So there are a variety of methods that sukuk can use to make a profit. It can use it on rentals. The sukuk can actually build a big shopping complex and then sell the shopping complex, or a property development and then sell the property development for a markup, for a profit. That profit is then distributed to the sukuk holders. As I say, there's a variety of ways in which the sukuk can make a profit.
Thank you, Prof. Our next question, should I be investing in fixed income Sharia funds or equity-based funds?
Okay, that's a financial advisor's question. I'm not going to, just give you an off-the-cuff answer. But what I would say is it all depends on your investment horizon. How you intend to invest, why do you need the investment, what do you need from the dividends, how soon do you need it, are you willing to wait, what would happen if there is a little loss during the period, how would you react to that? These are the basic investment profiling questions that any financial advisor would ask. Then they would give you advice on whether you need fixed income Sharia fund or a Sharia compliant equity fund. Naturally, a fixed income fund is less risk to an equity-based fund, but with less risk comes less reward. High risk, high reward, and that's the general spiel within the conventional and Islamic investment sector.
Okay, thank you, Prof. And next question, how do I ensure an investment is truly Sharia compliant?
Good, very good question. How do you ensure it? Well, as I said earlier, if you are using a financial advisor who has Sharia compliance background or knowledge, then they need to provide you with that certification. If you're going to an asset manager or a financial advisor who has a Sharia board or an advisory council of experts, now that is a lot safer. Then there's a lot of comfort because there's oversight, there's supervision. This board or this ACE, they are an independent body. They don't work for the institution. They are auditors at the end of the day, and they work for you. They make sure that whatever is done at the institution is reported accurately in terms of Sharia compliance, and they provide their own independent report on that. Once you see that report, at least you have comfort that this asset manager or financial advisor is truly Sharia compliant, and there are scholars, authorities in the field, skilled, qualified, competent personnel that are looking after the compliance of the institution. And you don't have to go and dig through, how and why it's Sharia compliant or conduct the screening yourself. All of that has been taken care of. And all you need to do now is decide how much you need to invest and what your investment profile actually is.
Thank you, Prof. Next question, why are Nigerian banks favor mostly Ijara to other contracts, e.g. Mudaraba, etc.?
It all depends on what the market needs and demands. So a Nigerian bank, which is non-interest, is going to provide products and services that the customers demand. That's how it's structured. If customers are looking for products and services that are more on a rental of asset basis, a rent to own, then that's what the non-interest bank is going to provide. However, saying that, the non-interest banks in Nigeria currently offer a variety of products and services. They offer mudaraba, they offer ijara and murabaha and istisna. So they have a variety of products and services. It depends on what the customer takes and utilizes. And you may see that customers generally utilize more ijara, and that's more prevalent in the market. So it's driven by customers, not necessarily by banks.
Thank you, Prof. Next question. Since Islamic investments are not interest-bearing, can Treasury bill be regarded as Islamic investment compliant? Also, what can be the alternative to fixed deposit and bond investment aside from sukuk, as these few and far between?
Excellent question. So the first part of the question, conventional treasury bills are interest-bearing instruments, and therefore they are not Sharia compliant. They are not Islamic investment compliant. What are your alternatives? Sukuk are your alternatives. So any sukuk that is sovereign-based or even corporate, but you'd need to check the risks, and you'd speak to your financial advisor who can assist you on that. What are the alternatives to fixed deposits? The mudaraba term deposit at a non-interest bank would be an alternative, and then the fixed income sukuk again would be another alternative. A halal fund that gives you access to the sukuk, like the FBN Quest halal fund, would naturally be the alternative to a fixed deposit or bond investment.
Thank you, Prof. Our next question is it permissible to invest in Amazon shares?
So I can't give you a fatwa or a resolution on any specific company because there may be differences of opinion. I would suggest that you speak to your financial advisor who is involved in Sharia compliant investments to give you that screening and to give you that opinion.
Okay, hold on. Okay, let me, what I have is an inquiry for FBN Quest actually. Do you have ethical mortgage facility? No, we don't. And any purchase facilities? No, we don't. Let me quickly go. How can the Islamic finance be more relevant in the Western world?
I think that it's all about economies of scale. Customers need to understand what Islamic finance is all about. Once they do, they can make an informed choice. And we find that, for example, in Malaysia, and this is a very important statistic that I'm about to state. In Malaysia, although we have 60% plus Muslim population in Malaysia, 60% plus Islamic banking customers are not Muslim. They're not Muslim. Now, this answers a question a bit later on that I see. Can non-Muslims access Islamic finance? The answer is absolutely yes. Absolutely yes. There's no restriction on who can invest Islamically, who can take out financing Islamically. Everyone has the opportunity. It's just your choice. And if you favor a more ethical approach, an approach that is more customer-driven, an approach that is more mutually beneficial, fair, transparent, then you'd choose Islamic investment or Islamic finance. So to be more relevant, once awareness is increasing, literacy increases, the natural option would be Islamic until, and this is what we're seeing as a trend, conventional becomes more responsible. Because conventional is seeing the market share that Islamic is eating up. And now conventional is deciding, well, I think we need to actually review the processes of what we've been doing. We need to become more ethical and more responsible because there's a big demand and a big market there. So yes, that is happening, and we do see many conventional institutions becoming more ethical.
Thank you, Prof. There are loads of questions, but unfortunately, we won't have the time to take all of them. But they will be answered. Thank you so much, Prof, for that impactful session. We thoroughly enjoyed it. It's always a pleasure. You always learn something when you speak. Thank you so much. We unfortunately, because of time, we have to round off. But as I said, the questions will all be responded to. We will send it, we'll answer them, Prof will answer them as well. Thank you for joining us on this edition of Leading Conversations with FB and Quest, which focus on principles guiding Islamic finance. We hope you found it interesting and engaging. And we have several more insights and relevant topics planned on the coming weeks and months. Follow us on our social media platforms, Twitter, Facebook, Instagram, and LinkedIn at FBNQuest today. There are also numbers that have been put in the chat box. If you have more questions, please send it to those numbers and they'll be responded to. Any inquiry, anything else that has not been responded to, please send it there. If you have any immediate questions, numbers are there. You want to send an email, send it to webinars@fbnquest.com. They will be responded to. Thank you again. As I said, it's always a pleasure. We appreciate you and we look forward to
Thank you. It is an honor to share that. Thank you very much. Thank you very much. It's an honor. Shukran.
Thank you, everybody. I hope you learned from this session. I hope you enjoyed it as I did. Thank you so much. Till next time.